Hello everyone and welcome to Young Sharks. This is Nakul and today we will learn how to do financial analysis of your startup. This tutorial is specifically for white sharks, that is for the 9 to 12 standard sharks, and you will be required to prepare a short financial analysis of your startup. However, it is still beneficial for the blue sharks to go through the tutorial as well. So, what is financial analysis? It shows how viable your business is and how much money it will make and at what cost. Imagine it like a doctor's checkup for your startup. By doing this, you will be able to realize whether your startup is healthy and will run for a long time. Doing financial analysis is very critical for a sensible entrepreneur. It is used to calculate the valuation of your company. It shows how much thought you have given to your business and gives a starting point for investors to figure out how the business will work. It is one of the final checks for a startup. If your financial analysis is not looking good, then you might have a problem on your hand. Not an unsolvable problem, but a problem still. There are three main components to financial analysis: revenue, or how much money you will take from customers; costs, how much money it will cost you to set up and run your business; and time, what is the time frame in which we are discussing the revenue and costs. Also, we will learn the term burn rate. This is a very frequent term used in startup circle, and we will learn how to calculate it. So, first let's start with setting up a baseline. It is very tough to do any kind of analysis without having a goal in mind. So let's set our goal first. Predict how much your business will grow in 6, 12, and 24 months. This will form the base for all your calculations. Your costs and revenues will come from this assumption. Doing this is hard and you might feel lost, but don't worry, we will deal with it. Do look at similar companies in your domain and how much they grew initially to get an idea. You can also schedule an expert call with us to get help on this topic. We will learn to do financial analysis using two examples. Example 1 is a company which runs a technology blog. A blog is a website where people post content for others to read. A technology blog is called Technocrats. Our second example is a see-through water bottle called Claret. As you will see, the financial analysis for them is quite different and is still sort of the same. Let's set up a baseline for these companies. For Technocrats, we'll measure the growth in page views. As the blog becomes more popular, more and more people will come and visit the web page. So the more page views it gets, the bigger the blog becomes. The target for Technocrats is that in the 6 months of starting the blog, we should be getting 10,000 visits per month. In the 12th month, we should be getting 1 lakh visits per month. And in 24 months or 2 years, we should be getting 10 lakh views per month. For Claret, we will measure the growth in number of bottles sold. The target for this company is that in the first 6 months, we should be able to sell 1,000 bottles. In 1 year, we should be able to sell 10,000 bottles. And in 2 years, we should be able to sell 1 lakh bottles. Let's look at revenue first. Our blog Technocrats earns money by showing ads to the people who visit our blog. You must have seen ads while browsing content online. Every time you see an ad, the owner of the web page gets paid from the advertisers for making you see the ad. Let's assume we get 0.1 rupees or 10 paisa per visit from advertisers for every visit on our page. So in the 6th month, if we are able to bring in 10,000 people on the blog, we should be making 1,000 rupees for that month. Similarly, in the 12th month, we should be making 10,000 rupees. And in 2 years, we should be making 1 lakh rupees per month. Pretty good, right? It's even better if you look at Claret. Let's assume we sell every bottle for rupees 100. So our revenue in the first 6 months would be 1 lakh rupees. In 1 year, we'll make 10 lakh. And in 2 years, we'll make 1 crore. That's much better. But wait, we haven't looked at our costs yet. For every business, costing would be different. For Technocrats, the major cost would be the web hosting cost and the content writing cost. We can ignore the marketing costs for now. For Claret, major cost would be manufacturing the bottles and shipping them, since we plan to sell them online. Apart from that, there is a fixed advertisement cost for Claret as well. Let's look at Technocrats first. Assume the web page hosting cost to be around 1000 rupees per month, and for the content you plan to write, 10 new articles or 10 posts per week, and every article costs you 10 rupees to write. That means your per week cost is 100 and your per month cost is 100 into 4, that is 4 weeks in a month, that is 400 rupees. Ignore the marketing cost for now. For Claret, let's assume manufacturing every bottle costs us 30 rupees to manufacture and 30 rupees to ship. Additional to that, let's assume we will spend 10,000 per month on advertising. After we have done these assumptions, let's look at our burn rate. A burn rate is a measure of how much money you will spend or burn in a month or in a week. Let's look at burn for Technocrats. The web page hosting costs are 1000 rupees per month and the content writing costs are 400 per month. So total costs are 1400 rupees per month and they do not change over time. So every month you burn 1400 rupees and in a year you burn 1400 into 12, that is 16,800 or about 17,000 rupees. This was pretty simple, right? Let's now look at Claret. Claret costs are a little complicated. Let's first look at how many bottles we need to manufacture every month to reach our target. In the first month, let's say we target to manufacture and sell about 50 bottles. In the second month, we will manufacture 100 and increasing from there. The curved line shows how many bottles in total we have manufactured and sold till now. So by June, that is the 6th month, we will have sold a little more than 1000 bottles. Which was our target, and in a year we will have sold a little more than 10,000 bottles, thus meeting our yearly target as well. Now let's look at what happens to our costs. In the first month, we spend 10,000 on advertising and we manufacture 50 bottles. Manufacturing 50 bottles costs us 50 into 30, that is 1500 rupees, and since these bottles will also be needed to be shipped to the customers, that will cost us 50 into 30, 1500 rupees again. So apart from the 10,000 advertising costs, we will have to spend 1500 manufacturing and 1500 shipping costs. So in total we will spend 13,000 in the first month, which you see as the tiny little column on the left side of the screen. The costs go up from there every month as we manufacture more bottles and ship them. In reality, manufacturing costs will come down as we manufacture more bottles, but for simplicity's sake, let's keep the cost constant. As you see, we spend about 7,35,000 in our first year of business. So now let's put our revenue and costs together for both companies and let's see what we get out of it. For Technocrats, we see that in the 7th month, that is July, our revenue becomes more than our costs. And after that, we start making profits every month. This kind of calculation is easy to represent on a graph and gives a clear picture of the financial health to the investor. For Claret, we see that in the month of May, we first break even. Breaking even is a term used when your revenue and costs are equal. That means your business is not losing money or making a profit. It is an important milestone in a startup's life, as usually once after a company breaks even, it soon becomes profitable. As you can see, the gap between our grey bars, which are our revenue, and the yellow bars, which are our costs, keeps on increasing, and the bigger that gap is, the higher our profits are. In the month of December, we'll be spending 1,90,000, but we will be making 3 lakhs from selling the bottles. This will earn a profit of 1,10,000 in that month alone. Pretty awesome, right? Some key points to note here. First, always mention your assumptions. Even if you think they might be wrong, stating your assumptions shows to the investors that you know what you're talking about and you know your calculations. Second, give some thought to your costs, how you should calculate them and how they will change over time. Be optimistic with your growth numbers, but not too much. Nothing turns off investors more than an unrealistic target. And last, represent your method of calculation clearly. If you need multiple slides to do it, use 2 slides, but make sure that they do not take up a major section of your presentation. This should not be the main topic of discussion with your investors. Feel free to use bar graph, equations, lines, or any other representation method to show your calculations. That's it for today. If you have any doubts on this session, feel free to comment on this post or mail us at hello@youngsharks.in. See you in the next video. Peace out.